Good morning. Happy Monday. Merry Christmas. Happy New Year on this last of the year edition of the Monday Market Update. My name is Nash Paradise, and as usual, I would be joined by my good buddy, Matt Gouget. Mr. Gouget is not available today, so you've got just me for a quick and expedited version of what's going on in the market. Where do we think things are going here in the future? And what does this mean for anyone in the industry? This is designed for realtors, lenders, interested home buyers, basically anyone who has anything to do with real estate or might have something to do with real estate in the next 6 to 12 months. This is for you. So let's go ahead and first, let's do a recap on what we saw last week. Obviously, it was Christmas week. We had a couple of days where trading was halted at 2 o'clock, markets closed on Christmas Eve, and then all day on Christmas. But we saw interest rates go up a good bit last week. The question is why? The great answer is there is no great answer. Yay. There's no real good reason for it. End of year positioning is the best viable option there. There was nothing really interesting in the numbers. Let's take a look at them real quick. Durable goods was fine. Core CapEx was fine. New York Treasury, no big deal. 2-year note auction, cool. Jobless claims, that's a big one. Nah, right in line with projections. You know, it was 220,000 last month. Projection was 224,000, came in at 219,000. Okay, that's not it. Continued claims, that can move the needle. No, projection 1880, came in at 1910. Previous was 1874. No big deal. Really nothing. Wholesale inventories, yeah, close, missed a little bit. Yeah, no one cares. Didn't matter. Market moved in a bad way last week, and there's not any real good data to support it. This is just trading. This is end of year. This is things moving around. You've got people selling off bonds and buying stocks. And then what happened this week? Well, we'll get into that in a second, but let's just say it's interesting without any good explanation. Let's dive into some charts here and take a look and see what they're showing as far as overnight averages on interest rates, where things are going right now. So if you're familiar with this chart, these are the 3 major conglomerates that track daily interest rates for mortgages. We've got the Mortgage News Daily, which is the one in blue, which is my favorite. It's the most accurate. We also have the Freddie Mac overnight average, which only updates weekly. And then we have the MBA Mortgage Bankers Association Index. So looking at these, blue line is one that we really care about. As you can see, just in the last few weeks, we've had a big spike. Things have gone up pretty rapidly as we crossed over the 7% threshold, came back down just a hair, popped right back up. So we're holding steady right now, 7.11%. Freddie Mac hasn't caught up. They're showing 6.85, and NBA is way behind, showing 6.75, even though, you know, NBA updated on 12/25, Freddie Mac on 12/26. It's just not very good data. But let's talk about dots. Let's talk about the Fed. Let's talk about where interest rates are going. I don't expect anything super interesting to be, going on right now. Any big updates from last week? If you remember, we just came off of the Fed decision to lower rates 25 basis points. Cool, expected, no big deal, except interest rates shot up a lot. What's going to happen in 2025? Well, I think we're going to be seeing anywhere from 2 to 3 total interest rate cuts instead of the 4 to 5 most people were anticipating. And that's likely why we got the knee-jerk reaction post-Fed. Anytime the Fed comes out and says things are going to be a little worse or a little higher for longer, people overreact, money moves, and hopefully we see some rebound from that. But let's go ahead and move forward here and take a look and see what we're seeing for projections on the on the January 29th meeting. This is as concise and consolidated as it can get. I think most of our Fed members are all charting for no movement. That 425 to 450 target should hold steady. We should not see a drop in January. There would have to be some major changes on that. So holding the line in January, not expecting a cut. Let's take a look at the March meeting. Let's see. For the 19th of March, this one's interesting. This one has moved a good bit since the last time we talked. I think most people, at least a week ago, when everything, consumer sentiment was a little more negative, we were thinking maybe not getting a cut until May, but this would show us a slight majority of the Fed believes that we're going to have another 25 basis point cut by the March meeting. So that, again, we're looking at March 19th. There's a lot of data that's going to be coming out between here and then. Obviously, the start of a new administration. There's a lot of rumblings going on right now with CFPB and some other of the major institutions that are backed by the government that host a litany of oversight and some overreach as it relates to real estate and mortgage lending. As we see how that shakes out, it will absolutely be moving the market. So right now for March, almost 50-50, but we've got a good bit of the Fed believing that's when we'll see our first quarter point drop. Let's take a look at May. May, funny enough, I would have thought by May we would have a much stronger majority showing that first quarter would already be into consideration, but we still have 37% on the dot plot that are not showing a mover even by May. That's not going to be great for interest rates. If we do not see a Fed drop, if we don't see enough, turning down on inflation, that could keep us pretty high through this spring buying season. And especially as, rates are holding steady, as inventory is chilling, the entire economy, the world economy, if not just US economy, needs a lot of turnover in real estate. That's where big money moves. And, it's going to become an interesting spring season. We'll talk about that a little bit later as we forecast out what this stuff means. Let's take a look at one more on the chart here. Let's see where we are by June. I would assume most everyone in the Fed is approximating that first quarter point drop by then. So let's see, when is the June meeting? I believe it's June 18th. Caden, do we have the slide from June?
We only have it through May on this slide deck, the next three.
All right, I'm getting ahead of myself.
Getting excited.
All right, well, you get to peel behind the curtain. You get to see my buddy Caden, who runs everything here. The dude is the dude, and it makes us look very, very good. So, and to summarize kind of where we are here on these, we don't necessarily, we've got the Fed dots, but we don't have anything conclusive looking June forward. But I'm going to say by June, we will have at least one drop. I think that if we don't, that's going to be fairly severe. But the interesting takeaway here is by May, 37.2% still showing no additional drop. Let's get into what's happening this week and see what we have on the docket. So this week, again, fairly uneventful. It's really weird when Christmas and New Year's Day fall on a Wednesday, right in midweek. It almost feels like neither of these weeks really have anything happening in the market. No real interesting news this week. We've got Chicago PMI this morning, as well as pending home sales. It does look like pending home sales surpassed expectations by a decent bit. The forecast was 0.7%. Previous figure was 2%, and what the actual figure came out at 2.2%. So pending home sales were fairly consistent with October. Now, if we remember back to last week, new home sales permits were down a lot. The total number of homes sold in 2024 versus previous years, we are all the way back to like 2009, 2008 levels. It is not great. It's a cyclical market. We're going to continue to see this for a little bit. Home sales and turnover in real estate is getting longer. For a while there, we were averaging 3 to 4 years for a lot of people on moving up, moving out, making changes to their mortgage, refinancing, scaling up. Money was coming in, everyone was doing good. But you think back to the 15, 20, 50 years before that, most people would be in their home 10, 15, 20 years. They may live in 3 homes their entire lifetime kind of thing. Now, it's just not the norm anymore. People are a lot more flexible. They move a lot more. They want that next level up. And so we've got a lot more delineation between, a starter home, a level up home, your level 3 house. And then you've got 10 levels above that just for, how aggressive you want to get. And as interest rates were dropping, you could jump from 300K to 450K and have the same payment, jump from 450 to 600, keep your payment the same. Those 3% rates really change the dynamic of housing. And in a normal market, that just doesn't happen. We're not going to have that much rollover. So I thought it was interesting seeing that we were going all the way back to, 15 plus years ago in the overall turn times for the market and the total number of transactions. That's not going to be great for the next couple of years, but finding balance is going to require less inventory, fewer buyers, less people moving around, and that could create some stability for your average family. But what it's going to do is going to make things a little bit more difficult for those first-time home buyers, as pricing is not necessarily going to come down without more turnover. Getting later in the week, obviously Tuesday and Wednesday, markets close early on Tuesday. They are closed on Wednesday. Nothing super interesting coming out. Thursday, we have continued claims, MBA purchase index, jobless claims. No surprises anticipated here. I mean, everything, the forecasts are all fairly in line. Friday, we have the ISM manufacturing PMI. Forecast is, within 10 bips of the previous figures there. So nothing at the start of the year is supposed to be really impactful or interesting, but it doesn't mean we're not going to get some movement. So taking a dive into what we're seeing today. Today has been aggressive. We have seen almost 40 basis points given back on mortgage-backed securities. What that means is mortgage rates are better by a good bit, 1/8%, maybe 1/4% in some circumstances. And the question everyone's going to ask is why? What happened? Why are mortgage rates better? And the answer is for no reason at all. I know, very helpful podcast. You're welcome. Thank you. There is no data driving this. If you wanted to try to assign some sort of value to it, you could say end of year positioning, that people, decided to put their money into bonds, sell out some stocks. I do think a lot of the sentiment for, more aggressive investors, hedge funds, big money players, a lot of our mutual funds and a lot of retirement accounts for sure. Everyone's a little wary about how the stock market is going to react early next year. And as the new administration starts taking action quickly, there's a lot of room for stocks to tumble. There's a lot of room for things to be, overbought right now and pricing to just not be consistent with where we expect consumer spending to be in the next couple of quarters. So with that said, it's completely plausible that we have more and more money moving into the bond market, that these bond auctions will pull a higher price, therefore driving down the yield. And as the yield, especially on the 10-year treasury bond drops, as the percentage that they pay to own 10-year treasury bonds goes down, mortgage rates follow. It's not a direct 1-for-1, but considering the length of time someone's going to hold a 10-year treasury, versus how long someone's going to be in a 30-year fixed mortgage, they tend to align closely enough that the mortgage-backed security pricing does a very good job of mirroring the 10-year treasury. Now, something that Matt and I have been talking about for the last few sessions has been the spread, the margin, the difference between the 10-year treasury yield and the mortgage-backed securities yields. This is still going to be my focus here the next couple quarters of watching and just seeing where things are going. Right now, we're looking at the 10-year treasury yield at 4.552. It was almost 4.7 at the end of last week. So glad to see that going down. But the overnight average on interest rates, 7.11%. That is 2.5% spread between the 10-year yield and the average 30-year fixed. That spread is not super healthy. That spread is exaggerated. That spread is not good for anyone. The average over the last 20 years has been closer to 1.8%. So if we were in a typical average market right now, even with the treasury bonds where they are, the yields where they are, we would be looking at interest rates in the 6.3, 6.5%. It's actually usually when the yields get really low and we have 10-year treasuries at, 1%, 1.5%, 2%. that's when that yield spread will get thicker, because you're going to take a little bit more margin when pricing is good. That's usually the time to make more money on these mortgage-backed securities. The fact is, we're in about the highest interest rate market we've seen, right close to it, and 40 basis points away, close enough. When we're around 7%, it's pretty high for most of us. And yet, despite the fact that we are in this high rate environment, we still have the largest yield spread that we've seen in the last 10 to 15 years. And there's no great justification for that. It just shows that the market isn't very stable, that the movement that we can have is very, very significant, and that everyone is wary about where real estate is headed over the next couple of years. They're going to take those extra margins. They're going to take that extra money. All it takes is for that to start thinning out a little bit. And we're going to see some nice bounce back on mortgage rates, which will push new home sales a little bit. It'll push existing home sales, push new applications. It moves money around, which is awesome for everyone. But that's going to be the key that I'm focusing on what we can expect here in first and second quarter, where we could get some nice gains, because the lack of any material Fed movement means we're not going to see it with the numbers necessarily. We're not going to see it with the data. We need other external things. Now, what one of those external things could be is the abolition of CFPB. CFPB is a Consumer Financial Protection Bureau, and it is in the crosshairs right now by the Trump administration. It has been targeted as potential government overreach and too much oversight. It's become cumbersome. Enforcement is difficult, which is a little scary. Having lived in the mortgage world back before CFPB, seeing the way certain things were done, greed is rampant. You see companies like Countrywide who are able to make billions and billions of dollars writing loans that never really should have been written. That didn't make sense when you say it out loud, like, oh, my rate's gonna be fixed for 2 years, then adjust, and I can't refinance out of this for 5 years, or I pay this huge penalty. Like, okay, why would I have a prepayment penalty? And I know my rate's adjusting. Not only that, you talk about what really drove subprime ARMs into such an ugly area. It was the margins. You may start with a 7% interest rate, but that 7% interest rate also had a 7% margin. And what most people didn't realize, what most lenders didn't do a good job of explaining, is you add that margin to your index. The index is, adjustable. That's what actually moves. That first adjustment, you're going to be 9, 10, 11, 12%. There's nothing you can do about that. It's going up. Prime ARMs, good ARMs, those have had margins in the 2% range, 2.25%, 2.5%. They're completely different loan product. It's apples and oranges. You add 2.5% to 1 year money, you're not going to lose your home. You add that, you take that 1 year money, that 1 year yield, and add 7% to it, 7.5%, 8% to it. Yeah, you're going to lose your home. Things are going upside down. It's going to be a really ugly spot. So CFPB prevented a lot of that. You could no longer do prepayment penalties in the same way. We had to prove the ability to repay, or ATR. That was huge. That was one of the biggest changes, is when writing a mortgage, we have to prove that you have a way to pay it. Now, that may be from assets. It could be from bank statements. There's some flexibility on the types of loans that can be written, the type of income that can be adjusted. But ultimately, you have to show the ability to pay your loan in order to be a qualified mortgage. Prior to that, if you had a 680 credit score and said you made 10 grand a month, cool. You paid your bills on time. We should assume you're going to keep paying your bills on time. That was exploited to the nth degree. And the problem is, when you can make money selling real estate as a realtor, writing loans as an originator, making loans and selling them on the secondary market as a servicer, and as a buyer, you just want what you want. Everyone is thinking about themselves, and that's just a very, very dangerous combination. People don't need that kind of fast track to get things that they, if something goes wrong, they're not necessarily going to be able to pay that going forward. So keep an eye out. If you see news about CFPB, if you see news about changes to, Dodd-Frank and any of the overarching real estate related legislation that's been passed in the last 10 to 15 years, that could move the market pretty severely. And that's a good reason to be in touch with your favorite local mortgage broker or, mortgage professional. And just, the news could be very, very interesting as we get in the first couple quarters of 2025 to see if there are any changes and anything going on there. Looking forward past that, forecasting without any new data this week, it should be a pretty slow, pretty calm week, only a couple trading days. So if we don't have any questions right now, I say we can pretty much wrap this up. The very last Monday market update of the year. Not a ton of stuff to go through, but a lot of really interesting things to watch going forward and things that we're going to keep an eye on. And as always, if you like it, lock it, work with someone local, find your trusted, in this case, Texas mortgage broker. But wherever you are, find a local mortgage broker. Make sure to ask them these questions. Tell them what you learned today. And if you are an industry professional, be watching and paying attention to the news, because it is going to drive things over the next 6 to 12 weeks for sure. So appreciate y'all for tuning in. And Matt and I will both be back next week to recap what we saw and to get into the very first Monday market update of the year. Thank you again. Y'all take care.